let's be honest. We've all been there. You've got the data, right? The objective facts right in front of you telling you one thing. But then there's this nagging gut feeling, this strong pull taking you in a totally different direction.
Oh, yeah. That feeling.
It's that classic human tension, isn't it? Between what we know is true and what we kind of wish were true.
That internal tug-of-war is incredibly common. And, it impacts everything from tiny choices to, well, huge financial decisions. It's just a universal human thing.
Absolutely. And that tension is precisely what we're plunging into today. Our deep dive is based on some really fascinating insights, sources like value versus belief in trading.
Right, from Sir Margin at Kumo Solutions, PDOI.
Exactly. And while the core ideas, yeah, they spring from trading, the lessons here, they really stretch far beyond markets. They offer a powerful framework for how you can approach pretty much any significant choice in your life.
Yeah, our mission today really is to unpack that critical difference, objective value versus subjective belief. We want to show you not just how they impact your choices, but why understanding that difference is so crucial.
Crucial for making more informed, more resilient decisions, whether you're navigating complex markets or just trying to make sense of daily life stuff.
And we'll get into some of those fascinating, maybe slightly unsettling psychological traps our brains set.
Without us even realizing it sometimes. We'll show you what those look like and maybe more importantly, give you some tools, some ways to disarm them. So yeah, let's jump right in.
Okay.
All right, let's start with this cornerstone concept, value. Our sources present it as the absolute foundation, right, for rational decision-making. And they stress it's way more than just the price.
That's right. What's so interesting here is that value is defined as, well, an objective assessment, something grounded in evidence, logic, measurable criteria. But it's not static either. It changes. It evolves with new information with different conditions, which, begs the question, if it's supposed to be so objective, why is it often so hard for us humans to, really grasp it?
That's the core challenge, isn't it?
Yeah.
Our sources break down different types of value, which helps. First, there's intrinsic value. This is like the inherent worth of something. Think of a company's fundamental strength, right? Assessed through tools like discounted cash flow models or maybe looking at earnings multiples.
So the better question there is this thing priced fairly relative to its actual underlying health? Is the price justified by the fundamental?
Gotcha. Then you have relative value.
Yeah, this one's all about context. How does one asset stack up against its peers? Or maybe against benchmarks.
Like comparing the price-to-earnings ratio, the PE, of two companies in the same industry?
Exactly. The PE ratio, basically what investors are willing to pay for each dollar of a company's earnings. It helps you see if something looks cheap or expensive compared to, others like it.
Okay. And then there's time value.
Right. Some assets, their value comes from their potential to grow, significantly in the future.
Like those early-stage growth stocks, maybe?
Yeah.
Little intrinsic value now, but huge potential down the road.
Precisely. If their business model really pans out, you're kind of betting on that future trajectory.
And finally, risk-adjusted value.
Yeah, this is crucial. It acknowledges that a super high return opportunity isn't really that valuable if the risks involved are just, well, way out of proportion.
So finding the right balance.
Yeah.
Potential reward versus the actual risk you're taking on.
Exactly. It's about that balance.
Okay, this next part is where it gets really interesting, I think, where the rubber meets the road. Even when we think we've got objective value nailed down, our brains, they have these sneaky ways of throwing up roadblocks.
Oh, absolutely. Cognitive biases.
Yeah, what are some of those common ones that just stop us seeing value clearly?
This is so critical because it speaks directly to the human element. Take confirmation bias. Imagine your brain's like a detective, right? But it's a detective that only looks for clues confirming what it already suspects. It actively seeks out info that supports what we want to believe about an asset's value.
And ignores everything else.
Pretty much filters it out, yeah.
Wow.
Anything that challenges our initial idea. Then there's anchoring.
Anchoring. Like being stuck on a number.
Exactly. We fixate on some arbitrary price, like saying, oh, I bought this stock at $50, so it must be worth at least $50. Even if the market's totally changed, the company's changed, that initial number sticks.
Right. And what about that really powerful urge to just Avoid admitting we messed up, even when the evidence is staring us in the face. Our sources call it loss aversion. How does that actually play out?
Oh, it's huge. Loss aversion means we tend to overvalue avoiding a loss compared to achieving an equivalent gain.
So losing $100 feels way worse than gaining $100 feels good.
You got it. That feeling of selling something at a loss. It often feels much worse than the potential relief or gain from getting out. So we hold on, hoping, praying it'll just come back.
Instead of cutting losses based on the objective value assessment.
Exactly, rather than making a rational decision. So for you listening, recognizing real value means actively, consciously working to develop a systematic approach. You need to identify it, quantify it, and constantly challenge these biases your mind naturally cooks up.
It sounds like a real discipline. Not easy.
It's definitely discipline. Takes practice.
Okay, so we've carefully picked apart objective value, the hard facts, the data. But what's that equally powerful, yet often, let's face it, less reliable force? The subjective one that leads us astray. That's where belief comes in. Our sources describe it as being shaped by, well, emotions, our personal experiences, the stories we tell ourselves.
Yes, and look, beliefs can be powerful motivators. They can inspire action. Think of an entrepreneur's passionate belief in their vision. That's crucial sometimes.
Sure.
But they become really dangerous when they diverge too far from objective reality. Beliefs are often the narratives we construct, the stories we tell ourselves, and honestly, those stories can be far less reliable than hard data.
So where do these powerful subjective beliefs even come from?
Our sources point to a few key culprits. Emotions, first off. Big drivers.
It's huge. Think about panic selling during a market crash. That's pure fear driving the belief.
Yeah.
This thing's going to zero.
Or the opposite, FOMO, fear of missing out during a big rally.
Exactly. Fueled by greed, maybe envy, leading to the belief, wow, this stock is going to the moon. I have to get in now or I'll miss out.
Oh man, I think we've all felt that FOMO trap. Seeing everyone else apparently making a fortune, and that little voice screams, "You're missing it!" It is so hard to resist that pull.
It really is. Then you have personal narratives. These are the stories we build, consciously or maybe subconsciously.
Like, oh, this company's so innovative, it has to succeed.
Yeah. Or the economy feels strong, so markets can't possibly fall. These narratives feel good, they're comforting, but often they lack rigorous evidence. We just want them to be true.
And don't forget social influence. Media headlines, you know those catchy ones.
Yeah.
Influencers on social media. Even peer pressure from friends. Absolutely. Our sources mention buying into the hype around meme stocks. Remember those?
Oh, yeah.
Highly volatile, driven almost purely by social trends. Or certain cryptocurrencies based on hype. Or just blindly following some analyst recommendation without doing your own homework.
So when these subjective beliefs clash head-on with objective value, that creates real problems, right?
Yeah.
Leads to poor decisions because of something called cognitive dissonance.
Exactly. That uncomfortable feeling when your beliefs and reality don't match up. It can manifest as overconfidence. You hold on to losing positions because you just believe your initial thesis must be right.
Unwilling to admit you might have been wrong. Ego gets involved.
Definitely. Or denial. You just ignore clear warning signs like a company's fundamentals going downhill because you're emotionally attached to your belief about its bright future. You just can't face it.
And then there's the herd mentality. Just doing what everyone else seems to be doing.
Yep. Acting purely on collective sentiment, following the crowd, instead of doing your own independent, value-based analysis. To counter all this, you really need to get in the habit of challenging your beliefs regularly against hard data and be willing to change your mind.
Even when it's uncomfortable.
Especially when it's uncomfortable. That's often when you need it most.
Okay, so we've got these two forces, objective value, subjective belief, often pulling in opposite directions. But in the real world, things are rarely black and white, right?
Yeah.
Nothing's 100% certain. How do we navigate that tension?
Great question.
Our source introduces probability as the bridge, a way to acknowledge uncertainty, but still make informed choices.
Precisely. Probability lets us make decisions while explicitly acknowledging, hey, we don't know the future for sure. But, and this is key, these probabilities must be rooted in evidence, not just speculation or wishful thinking.
So grounded probabilities, like using historical volatility, looking at past performance to see how likely an asset is to move within a certain range.
Exactly. Using historical data as a guide while knowing it's not a perfect predictor. Or employing statistical models like Monte Carlo simulations.
Ah, those run thousands of possibilities.
Yeah, they estimate a range of potential outcomes based on various inputs and their probabilities. It gives you a sense of the distribution of possibilities, not just one single forecast.
And even simpler things, like scenario analysis, evaluating different conditions, bullish, bearish, neutral, and assigning probabilities.
Absolutely. Mapping out the potential futures, giving each a weight based on evidence. It's about preparing for different outcomes, not just banking on the one you prefer.
But here's the catch, right? Even when we try to use probabilities, our sneaky beliefs can still creep in and mess things up.
Oh, for sure. For instance, recency bias. We tend to overestimate the likelihood of recent events repeating.
So if the market's been going up for a while, we think it'll just keep going up indefinitely.
Yeah, we might assign an irrationally high probability to that continuing, kind of forgetting the bigger picture, the historical context where markets also go down.
Or overfitting, creating these super complex models that perfectly explain the past.
But then completely fail to predict the future because they're too tailored to historical quirks, like trying to force fit data. They